Welcome to part 1 of topic 2, production costs, and in this topic we're looking at how production costs actually vary as firms change their level of production. So what we're looking at in this particular presentation is accounting profit versus economic profit, and the distinction is very important, as you'll soon see. And also we're drawing a distinction between two different periods of time in microeconomics, and that is the short run versus the long run. Now, in terms of economic profit, I've set up a little scenario here, and we've got an accountant who was earning $120,000 a year, and she leaves her job and purchases a small farm. Now, during the first year of operation, I've got revenues there of $800,000, and I've got three categories of operating costs. So we've got fixed costs, variable costs, and then the cost of capital. And so the question is the farmer making a profit? Well, an accountant would look at that and say revenue is $800,000. Those three costs total $700,000. So an accountant would say, yep, the farmer is making a $100,000 profit. An economist, however, would look at those numbers and say this person is actually making a loss. So what is the distinction? Well, to start with, on this slide I've got accounting profit here calculated as $100,000. And that definition of profit is a perfectly valid definition, and that's the one that you'll be learning about in your accounting unit as part of your studies. And this farmer would presumably earn the $100,000, pay tax on that, and whatever is left over, the person would split between savings and consumption. However, an economist wouldn't define profit that way. An economist would actually define it as I've got one line down. Economic profit equals, well, it's actually a $20,000 loss, because in economics, in addition to those three types of costs that I outlined for $150,000, $400,000 and $150,000, we also include opportunity costs, and that is the $120,000 that this person could have made working as an accountant if they hadn't switched their labour over to farming. So, in this sense, how do we interpret this $20,000? This $20,000 loss here, this negative economic profit. Well, that $20,000 loss is really comparing the profit that the farmer made farming with their next best alternative, which is working as an accountant and earning $120,000 a year. So this economic profit of minus 20,000 is really saying that this person made a loss by farming relative to the amount of money they could have earned if they had worked as an accountant. So the concept of economic profit is really comparing the current employment with the next best alternative. So in a sense, it's comparing what is actually going on with the next best alternative. And if we were just looking at this farmer's options from a monetary sense, then it would make most sense for this farmer to actually go back to accounting, unless these numbers change in some way. Now, this idea of opportunity cost, that is your next best alternative, those opportunity costs are actually built in to the cost curves that we'll be dealing with later on in this topic. Okay, so therefore in microeconomics we consider fixed costs, variable costs and opportunity costs as well. So to be doing well in an economic sense, you have to be earning enough revenue to cover your fixed costs, your variable costs and your opportunity costs as well. You have to earn enough revenue to cover those opportunity costs. Okay. So that concept of economic profit, that'll become very important when we start looking at the cost curve. So we will come back to that concept of economic profit. But now there's an equally important concept that we have to understand, and that is the distinction between the short run and the long run in economics. The short run is a period of time when at least one input cannot be varied, and we normally refer to that as capital. And the long run is a period of time when all inputs can be varied. Now, over the years I've had a lot of people ask me, well, how long is the short run? Is it 6 months? Is it 12 months? Is it 2 years? It depends upon the industry. The short run is a period of time where your capital is fixed. Now if you're running, let's just say you're running a hair salon and you've got some spare room in the back of the shop. If you want to actually increase your capital, which would be items such as the chair, the mirror, and all of the other sorts of capital equipment that go into running a hair salon, then it would probably take you maybe 2 months to get the chairs in, to get the mirrors installed, and actually increase your productive capacity by having more capital. So in the hair salon industry, the short run may be a period of, say, 2 months. In the mining industry, however, to significantly increase the productive capacity of a mine by introducing more capital, that can take several years. So in the mining industry, the short run could be 3 or 4 years. So I can't give you a nice, neat answer in terms of how long the short run actually is. It depends upon the industry. Okay, so then the next question is, why is this distinction between the short run and the long run very, very important? Sometimes people read about this distinction, but they're not fully aware of why it's an important distinction. And what I've got there is that it's important because it affects how firms actually increase their production levels. So if a firm experiences an increase in production in the short run, the only way of satisfying the increase, if a firm experiences an increase in demand in the short run, the only way to satisfy that extra demand is by employing more workers, using the same amount of capital you have, because capital is fixed in the short run, and producing more that way. However, if we're dealing with the long run and a firm experiences an increase in demand, then the firm has the option, won't necessarily do this, but it does have the option of increasing both labour and capital. So you can imagine that there would be very different price dynamics going on when you, A, can just increase production by increasing labour, versus B, increasing production by increasing both capital and labour. Okay, the relationship between production and costs are very different under those two scenarios, i.e. the short run and the long run. So that's why it's very, very important. We have to do separate types of analysis when we are considering production changes in the short run versus production changes in the long run. Okay, because the relationships between production and costs are different in those two periods of time. Okay, so let's think through this example, and I've already sort of spoken about this in the last couple of minutes. Assume you're running a manufacturing plant and experience a 30% increase in demand. So let's just imagine that you have a factory with, say, 5 machines, 5 pieces of capital equipment, and you experience an increase in demand, and you want to match that by increasing your production. How are you going to do that in the short run? Well, the only way of doing it in the short run is you've got a fixed amount of capital, so you'll have to employ more labour. And as you employ more and more labour, you're going to have to work the capital harder and harder and harder. And what you're actually going to experience in the short run is rising production costs. So as you try to produce more and more and more in the short run using a fixed amount of capital, your production costs are going to rise. So your marginal production costs are going to rise. Compare that to the long run. Let's just imagine that we have a 30% increase in demand, and we want to match that with a 30% increase in production. We also assume that we believe that the increase in demand is permanent. So it's not just a temporary thing where production will need to go back down to its original level quickly, but it's a permanent increase in production and thus permanent increase in demand and thus production. How are you likely to respond then? Well, if we know it's a permanent increase in demand and therefore production, it doesn't make any sense to keep capital fixed and just adding more and more labour, because capital will be worked too intensively, the capital equipment will get crowded, there will be too many people trying to access that capital equipment in the short run. So if we're dealing with a longer run period of time, the long run, it would make more sense to respond to this increase in demand by increasing production by increasing both capital and labour. If we can increase both capital and labour, then we aren't restricted in terms of the amount of capital we have. We can freely increase capital to the optimal level and probably take advantage of some economies of scale. Okay, so hopefully that explains why